Hi, my name is Gregor Weiss. I'm a professor of finance here at Leipzig University, and I want to welcome you to this new video on sustainable finance. In the previous video, we talked about externalities being at the very core of our problems when it comes to sustainable finance and the interaction of financial markets with the environmental and social challenges that companies face today. And as we've seen, externalities cause problems to us because by consuming certain goods or services, market participants are actually not incorporating the negative side effects that consumption has on the environment and on other market participants in their consumption decision. It's not priced in. And now we want to talk about two basic approaches how to reduce externalities. And the first one is very simple. We should raise prices through taxation to reduce overdemand. We have too high demand, for example, for gasoline, natural gas, and other fossil fuels. And because we don't actually recognize the true price that our consumption should have, we are using too much. Gasoline should be more expensive because of its negative side effect on the environment via carbon dioxide emissions. So we are using up too much fossil fuels. So the government can step in and say, if the market fails and is not able to set prices right, we will increase prices by putting an additional environmental tax on top of the market price. So that's raising prices through taxation. The other approach is to limit quantities directly through regulatory quotas. So, for example, you could argue that a maximum of a couple of billion liters of gasoline should be used every year, and that's the maximum amount we want to use. Thus, of course, carbon dioxide emissions are capped at the very top, and then every year we could reduce this overall maximum cap and reduce emissions via that. But then, of course, if we do it directly through regulatory quotas, we are not touching prices directly, but prices will adjust accordingly. So basically the two approaches will give you the same result unless the demand curve is uncertain, because then if you are not sure about how demand will evolve, then of course both approaches can give you different results. A good example for this is the EU emission trading scheme, the EU ETS for carbon dioxide emissions a couple of years ago. When it started, the European Union didn't really know how to set the maximum cap on that EU emission trading scheme. And what happened is they set the cap way too high and prices immediately fell down to the bottom because there were too many carbon dioxide emission rights and companies were not willing to pay for these emission rights. So these are the two approaches we want to talk about. Why should we integrate ESG factors if we assume the position of an investor? Well, of course, if you anticipate such a kind of regulation or taxation, for example, a carbon tax or a carbon dioxide emission rights scheme, then of course you should already now integrate those ESG factors into your investment decisions, into pricing, because this will at some point in time hit you as a company. A second reason why you should integrate ESG factors is that you might get pressure from NGOs and consumers, and this will lead to reputation risk. If you suffer from reputation risk, you might lose clients, you might lose suppliers, you might lose the support of lobby groups and politicians and face tougher regulations. So it makes sense to consider reputation risk. And last but not least, if we are trying to achieve the Sustainable Development Goals by 2030, then of course this will make your company and your investments more future-proof. To give you an example of reputation risk, just consider this news report on Heineken in South Africa. It's actually possible to look at reputation risk from many perspectives. But this is a very good example because in this case, Heineken was criticized by NGOs for not paying a decent living wage. And this is a very simple, very hands-on example of how companies could face the risk of reputation risk and being criticized not just by NGOs, but by customers, clients, and their own workers. And if you don't pay a decent living wage in a country, in this case, of course, outside your headquarter state, then in this case, you will get bad reputation and you will lose customer support. A different example for a regulatory approach. You might remember that actually in the 80s and 90s, mankind wasn't so much concerned about climate change. We still call it the greenhouse effect, but weren't really that committed to fighting climate change. What at that age seemed more important and more dramatic was the hole in the ozone layer in our atmosphere causing ultraviolet radiation to cause health problems, especially in Australia. And the hole in the ozone layer was caused by certain substances, most famously in spray cans. So what happened is governments came together and they agreed in the Montreal Protocol to stop the production and the emission of a select group of substances that caused the hole in the ozone layer, that depleted the ozone in the upper spheres of the atmosphere. And this was a very successful example of a protocol and a regulatory and governmental, intergovernmental approach to stop this environmental disaster. And even though it will take a couple of decades for the ozone layer to fully recover, at least we are seeing that ozone layer is recovering, that it's no longer in the process of further depleting. Now, taxing externalities. Taxing externalities means that we need to come up with a price for the externality of, for example, carbon dioxide emissions. A carbon tax is a very efficient way to get public good of low carbon economy. And what we need to do is we need to find the marginal adjustment cost of carbon dioxide emissions. And this needs to be the amount that we put on the price as a tax. The alternative to such a carbon tax, where we need to come up with a price for every ton of carbon dioxide that is emitted, the alternative is a quota system. For example, the emissions trading system or the EU ETS, the European Union Emission Trading Scheme. It's a cap and trade system where you set a global or a local cap for carbon dioxide emissions. For example, I'm making up an example, let's say 1 billion tons of carbon dioxide, and you then distribute emission rights to companies. You might extend it to households, then to households for free, based on a calculation you do or based on the emissions that you have right now. And then you allow firms, households, persons, right now it's just firms, to trade on those carbon dioxide emissions. And companies who don't change anything, they will just get a certain amount of carbon dioxide emission rights for free, and they will use up those emission rights in this year, and they will get nothing. It's a zero-sum game for them. But if you're a company who decides to invest in new environmental technologies, if you invest in technologies that reduce your carbon dioxide emissions, you are actually able to sell a part of your emission rights. And a company that actually even increases their carbon dioxide emissions, they will need to buy up additional carbon dioxide emission rights over an exchange, from an exchange. And then they will have to spend extra money on being a high polluter. So this is a cap emissions and trade system where you set a global cap for the aggregate amount of carbon dioxide emission rights, and then you allow trading, and every year you reduce the cap slowly, bit by bit, making sure that the overall aggregate carbon dioxide emissions are reduced over time. So that's the idea of a cap and trade system. And taxes on natural resources, they also prevent, of course, depletion. But what we find most, or what we are discussing most right now at the time, is a carbon tax and an emission trading system. Some carbon taxes in practice. Actually, Scandinavian countries started back in the 1990s, and now we have prices of approximately $50 to $130 per ton of carbon dioxide equivalent. And the result is, of course, a reduction in emissions without a heavy loss of economic growth. And the key is redirecting the taxes. So you tax carbon instead of labor. And this is also the current discussion in Germany, that we should tax carbon dioxide emissions. We should use the funds that we make out of taxing and the cap and trade system, and we should use that capital and reinvest in companies that reduce their carbon dioxide emissions, and give it back to private households if they have to carry the high burden of paying additional taxes. There are, of course, laggards. Most countries have no effective carbon taxes, and even worse, some countries even are still in the process of subsidizing fossil fuels, up to even $300 billion. And one has to see that subsidies are actually very inefficient in supporting income in low-income countries. So the best way to move forward, I guess, is to get rid of those subsidies, especially the ones for fossil fuels, and think about introducing carbon taxes and cap and trade systems. Now, for environmental externalities, especially carbon dioxide emissions, this seems to be quite easy, even though it's not easy politically. It is easy when it comes to the technology needed to install such a system. Why? Because carbon dioxide emissions are pretty relatively easy to measure. You only emit carbon dioxide emissions if you burn fossil fuels, basically. So it's easy to compute the amount of carbon dioxide emissions that are caused by, for example, burning 1 gallon of gasoline or diesel. What is more difficult is taxing and pricing social externalities. So, for example, if you look at high-income countries, we have maximum working hours, we have health and safety regulations in place, we are trying to get a better gender equality, to reduce the gender pay gap, and have a minimum wage. But in low-income countries, you will still have a pretty bad human rights situation. You will find child labor, maybe even slavery and underpayments. So what you need to do is you have to come up with certain instruments like a living wage, which is instrumental for other SDGs as well. You have to try to change behavior by taxation, for example, put taxes on alcohol, tobacco, sugar-rich beverage, etc. So it's first much more difficult to measure those externalities, and second, you need completely different tools to make sure that companies price their social externalities right. So, as I mentioned, this is the one and only first and most important step. We need to measure and price externalities. So it's a first step for any company to address and mitigate remaining externalities. We need to measure these and we need to price them. So attaching a financial value to social externalities in particular, but also environmental, of course, it facilitates the optimization process among the financial, social, environmental dimensions. If we want to come up with an integrated value that is not just the financial value, but it takes into account the social and environmental concerns and externalities as well, we need to price them. Innovations in technology allow us, via a better measurement, information technology, more data availability, and better science, life cycle analysis, social life cycle analysis, etc., to make monetization of social environmental externalities possible and be more precise. And in this way, we are then able, or ideally we are able, to come up with an integrated value that is just the sum of the financial, social, environmental value of a good or a service. Okay. Now this is an illustration of this idea, we have the financial value, but usually the social and environmental effects are negative. And these are externalities that need to be accounted for, that need to be integrated together with the financial value. And suddenly we get, for example, not a value of 15, but we get an integrated value of 9 or 12, and we need to optimize this. So we might actually be able to reduce the social and environmental externalities by 4, and only for going on a financial value of 1 to increase the integrated value from 9 to 12, as shown here in this plot. Now, a discussion for you to do at home is who acts first, who should act first. Now, when it comes to taxation and regulation, it's usually the government. But the problem is you cannot, and we shouldn't wait for governments to do the job for firms altogether. It probably needs to be a joint combined effort by governments introducing taxation and regulation, and firms, smart firms actually, to anticipate these types of government interventions and state interventions to make sure that they are ahead of the herd and that they are actually looking at integrated values way before the competition does. So usually it's the government who will act first, but the government is also very, very slow, and smart companies will anticipate this type of regulation and intervention and look for social and environmental externalities way before that. So what can businesses do with remaining externalities? Again, measuring and monetization is possible through better technology. With IT, data, better analysis, we can try to put a price tag on social and environmental externalities way before this is done by governments, and this will of course make sure that we are not caught off guard. If you just wait until a government suddenly introduces a carbon tax, you might try to fight this via lobbying groups, but it's much smarter to come up with your own price, include it in your business model before the government does this and you're again caught off guard. One example for this is, for example, the true prices of roses from Kenya. The conventional price, looking at the financial dimension, would actually be 70 euro cents. But if you include social and environmental concerns, the true price should rather be maybe €1.92. And what you can try to do is you can optimize the true price by reducing the airplane transportation, so transport by ship will reduce carbon emissions. You can try to use solar-powered greenhouses. You can try to have a closed-loop hydroponic system to reduce water and fertilizer use. You can reduce the gender pay gap, pay a basic living wage, to train in health and safety, etc., etc. So you will reduce the social and environmental externalities by a lot, and you might actually come to a price that is optimized, that is only slightly higher than the conventional price, and you don't need to think too much about driven out by the competition, and it's just a small price to pay to actually be prepared for any type of regulation or additional taxes that might hit in the future. What are some pitfalls to monetization and measuring externalities? Of course, if it's only done on efficiency grounds, this might not lead to the best results. For example, you still need to invest in adaptive capacities to absorb shocks. It's not sufficient to just think about reducing carbon dioxide emissions altogether the quickest and invest and redirect all your capital into just carbon dioxide emissions. Unfortunately, you have to think about adaptive capacities as well. Make sure that you're safe against more natural disasters, that you can actually cope with a rise in climate and climate temperature. Another example is to overinvest in safety to protect people and environment and to reduce production losses. This will, of course, also be counterproductive. If you spend all your money on all these measures to counter social and environmental externalities, then, of course, you might actually go bankrupt. You also have ethical aspects of externalities to consider. For example, it's very, very difficult to monetize ethical aspects like human rights. Our understanding of ethics will change over time, and the three capitals, financial, social, and environmental, they should not be substitutable. So make sure that if you measure ethical aspects, do it properly and be careful that your understanding of ethics might also change, and you shouldn't play social, environmental, and financial externalities against each other. Okay. And last but not least, you might actually get perverse outcomes. If you just think about financial, social, and environmental concerns, and you just try to monetize everything, you might still get to a situation where you would say, okay, actually, a complete deforestation of the rainforest will give me a result that is still better, even if I were to consider the negative impacts of deforestation. So just concentrating on sheer numbers might still give you a perverse outcome, because you might end up saying, okay, complete deforestation and disregarding all environmental concerns is still better than doing at least a little bit of safeguarding the rainforest. So in the end, of course, you cannot put a price tag on everything. And last but not least, we still have uncertainties to consider. We do have technological uncertainties. Let's start with those. We have exponential growth and new innovations, and a spectacular rise of renewables will lead to new developments. It's fascinating to see how quickly we actually introduced electric cars. And Moore's law says that the doubling of capacity happens every 2, 3, 4, 5 years. But we will also see changes in consumer behavior and preferences, and ideally these will lead to a higher demand for electricity, green electricity. This will lead to less acceptance and low acceptance of fossil fuels. So we have technological uncertainty that at least we know that we will go green and we will become more sustainable in the future, but we cannot really anticipate where and when this will all happen. And last but not least, we of course have policy uncertainty. We do know that governments will react. Governments will introduce taxes and regulations, but we don't know which regulations will come and when, and to which companies and industries these will be applied. And we might actually also see some reversal. That means policies that will be reversed, changed when it comes to subsidies, solar panel subsidies, for example. And we are operating in a world where we will have to deal with both policy and technological uncertainty. Okay, so what are the main takeaways? Let me just get back to the slide. What are the main takeaways you should consider? Well, social and environmental externalities are extremely relevant in not just today's industry. It has been, and they were back 100 and 200 years already, but they are absent in traditional production functions. Companies, managers usually only consider financial effects, and they do not consider externalities caused by production and consumption that is laid out to other market participants, other companies, and the world as a whole. So we need to change this neoclassical financial approach and internalize externalities. Government need to introduce taxes and regulations. It's first best, but not always done. And businesses need to incorporate social and environmental externalities in their decision making, finally arriving at an integrated value of their products that will, of course, slightly increase prices, but will also consider reputation risk. It will anticipate future regulation and taxation. So in the end, this should be better for companies as well. And one idea to deal with uncertainties is to do a scenario analysis where you compile certain scenarios. For example, what would happen to my company if we introduced a carbon tax at, let's say, 50 euros? 100 euros per ton carbon dioxide, etc. And then we can calculate the value of the company under these different scenarios and see how we should react and how we should prepare our company for these scenarios. So these are the key takeaways from this video and the previous one. And I hope you now understand the concept of social environmental externalities, and hopefully see you in the next video. Thanks.